Hello, good evening and welcome to this wonderful topic Division 2 of Schedule 3 to the Companies Act 2013. Have you ever seen a balance sheet based on Ind AS? When did you see? In your annual reports. So I have got the annual report of a company called Signity. Okay. So today you will also download some annual report of any company and you will go through it. Then you will get an idea how these companies prepare their balance sheet. And exactly same thing we are going to learn today, and you will apply in your offices. Post qualification also you have to prepare financial statements. So exactly what you learn is applied in practice also. So the purpose of Schedule 3 is that financial statement should be prepared in a standardized format. All companies should prepare financial statement using a standard format, in a standard manner, standard disclosures, and it is very close to the financial statement under IFRS also. So our financial statement can be compared with IFRS based financial statement also, although there are some changes because of Indian business, economic, legal environment, but still more or less now it is very close to the financial statement prepared by other global companies. So therefore easy for the investors to make the comparison. And when the financial statements are standardized, it is easy for users to understand it. They can be trained to understand financial statement in a certain format. If every company prepares financial statement as per their convenience, then you will not be able to understand their financial statement. And when they are presented in a proper format, we love to read it also. Is it right? It is like having snacks on the roadside vendor, or when you go to a 5-star and enjoy the same snacks. What is the difference? Not just the quality. Quality is better in the roadside, the taste, but the presentation, the way they present in a 5-star hotel, that makes you really enjoy that food. Okay, you like that food. So that is why presentation of financial statement is also very important. Nowadays it has become like a marketing tool also. If you look at the annual report, like this annual report I called from the company, so they will prepare very nicely also, okay, with all the color combinations. You feel like reading it also. There are some companies which are not very much interested, like this company NDTV, now owned by Adani. So when I called for the annual report, they probably did the photocopy and they did the stapling. This is their presentation, not I have done. I got it from the courier just day before yesterday only. This is how they present with a stapler also. So different companies have different presentation skill. So I read that other balance sheet fully, almost fully, not line by line, but all pages. But this I have not yet opened also. It is not inspiring me to open that. Okay. So good evening everybody who have joined online session and on the YouTube channel also. If you have any doubt at any stage, you can ask me. So let us begin. I hope you have received the notes, PDF notes. Those who have attended online, you can download the notes, keep it with you, so that sometimes we have to write something in the notes, you can write it. Keep the printout ready. Okay. So first is Schedule 3. Is going to give you the format for the balance sheet, profit and loss account, and certain disclosure requirements. Schedule 3 has 3 divisions. Division 1 is for companies which follow accounting standard. Division 2 is for companies which follow Ind AS except NBFC. So you have to write it down in the book. To keep the students also engaged, I will make you write down something in the notes. So who will follow Division 1? Companies which follow accounting standards. Of course, other than banking and insurance companies, because for banking and insurance companies we have separate format given by RBI and IRDA. Okay, this you have already studied in the intermediate syllabus. Division 1 you have studied in the intermediate syllabus. Do you remember? You had a chapter financial statement of companies. That was schedule 1, they have taught you. Division 1 of schedule 3. And our final syllabus is this. Any chapter where they will ask you to prepare balance sheet, P&L account, notes to account, disclosure, it will be as per division 2 of schedule 3. Whether they specifically mention it or not, our syllabus will answer all formats of balance sheet, P&L account, etc. as per division 2. It will be applied by Ind AS companies except NBFC. And then division 3 will be applied by NBFC which are following Ind AS. Those NBFC which are following Ind AS will apply division 3. So should I share one good news? That is, division 3 is not applicable in your syllabus. Division 3 is not applicable. So we don't have questions where we have to prepare the financial statement of NBFCs which comply with Ind AS. Is it right? So we are going to learn today division 2 of schedule 3. Have you noted it down? One student has a query in the classroom. Yes, come on.
NBFC which are not following Ind AS will do as per schedule.
Yes, of course. NBFC which are not applying Ind AS, they will follow division 1.
So formats will be same in non-NBFC, NBFC.
Yes.
But then why is it different for Ind AS?
Because in Ind AS the requirements are very different. Presentation is different. Disclosures are different. For NBFC also.
Major differences?
I have not seen because it's not in the syllabus, so I don't know exactly what is requirement, because already our life is miserable learning so much. So what is not in the syllabus right now, we are not focusing on that. Okay, but if time permits, I will check. Next is, what is the format of statement of P&L account? If you want to read the bare text of division 2 of schedule 3, it is printed at the end of our book. Those who have the notes, bare text means exactly what is division 2 of schedule 3 is printed on page 2.38. Page 2. Not page 2.8, sorry, just a minute. On page 2.44. Page 2.44 in your book. If you have the notes in front of you, annexure A for self-reading, that is exactly the requirement of division 2 of schedule 3, which gives you the format and the requirements and the disclosures, etc. Is it right? We will simplify that for our classroom discussion. Okay, and whenever you get time, you go through it once. In the exam, they usually ask a question on schedule 3 where a long problem will be given, which will have a balance sheet, P&L account, several adjustment, and you have to prepare the financial statement as per schedule 3 division 2. Okay, they don't usually ask theory question on this. So focus should be on understanding the requirement of division 2. Are you ready? Okay, so good evening everybody who has joined just now. So first we'll see the format of statement of profit and loss, which is very similar to, but not 100% same, to what you have learnt in intermediate division 1. So we'll start with the heading which is called statement of profit and loss. Okay, in IFRS they call it statement of comprehensive income, but in our division 2 we have called it statement of profit and loss, because Companies Act uses the terminology statement of profit and loss. Then you will write the name of the company, you will write statement of profit and loss for the year ended, and rupees in whatever is the rounding of you have used, in thousand or in lakhs or in million. So as a student you will do the rounding off in the same way it is given in the question. The question is in million, you also solve in million, otherwise every figure you will have to change. Okay, and we give two columns. First is the current year reporting, current year, and second is the previous year for comparison, so that the users can check whether the sales are increasing or not, profit is increasing or not. So we have revenue from operation. We'll discuss line items separately. Other income, total income. Right now don't ask question what is other income, it will come in your discussion. Expenses have following headings: cost of material consumed, purchase of stock in trade, then change in inventory of finished goods, stock in trade, and work in progress. Change in the stock will be opening stock minus closing stock. If you look at these two together, see the logic. If you look at these two together, you have opening stock plus purchase minus closing stock, because purchase has come here, opening minus closing has come. What together they are known as? So basically cost of goods sold. So what you have written is cost of goods sold. Then you have employee benefit expense. So all employee related expense will come here. Then one Mr. Ramesh Pawar is saying hi. Okay. Pawar name nowadays is very popular. Finance cost. Okay. You are Ajit Pawar. Seriously?
Yes. Official.
Now I have to be little careful while talking anything.
No, sir. Don't worry.
Employee benefit expense. One Mr. Ajit Pawar is sitting in the classroom and Sharad Pawar is online. Finance cost. Finance cost means all interest and borrowing cost will come here. Depreciation and amortization, other expense, total expense. So this is total expense here, and this was total income. So what will you get? Total income minus total expense. You will get profit or loss before exceptional item and tax. Then you have to present exceptional item if any. In IFRS there is no concept of exceptional item, but in Ind AS we have exceptional item. In schedule 3 we have exceptional item, something which is not very frequent, okay, something which is not regular or related to day-to-day operation, where the management wants to highlight it separately. Like for example, you have a profit on sale of a machine. Now you don't sell machine every year or every day, it's not your day-to-day activity. So if you want, you can show it separately, so that somebody who is analyzing the performance of the company will understand that this item is not going to occur every year. So when he is projecting the future profitability, he will keep this item separate and then make projection about the future profitability. Exceptional item. Then we have after exceptional item, profit or loss before tax. So it should be 5 plus minus 6. Why plus minus 6? It can be profit also. It can be profit also. Then we have tax expense, current tax, deferred tax. Deferred tax we will study after some days in Ind AS 12. Current tax is tax payable as per the income tax law. Deferred tax is the tax adjustment for the difference in assets and liabilities appearing in books and their tax base as per the taxation law. So which is a little complicated standard. So we will not discuss deferred tax today, but only in one problem there are few adjustments which I have to take. So you have to trust me today for deferred tax calculation. Okay. You will get profit or loss for the period from continuing operation, and if the entity has a discontinued operation, which we are going to discuss in Ind AS 105, you keep writing so that you will remember the numbers. That is, we will calculate any profit or loss from discontinued operation before tax, tax expense of discontinued operation. You will get profit or loss after tax from discontinued operation. So paragraph 9 on the screen is profit or loss after tax from continued operation. Paragraph 12 on the screen is profit or loss after tax from discontinued operation. So if you add the two, that will give you total profit. Is it right? This up to this is called part 1 of the statement of profit and loss. Up to this is called part 1, where we show profit and loss items. Part 2 is called other comprehensive income. I will explain this, don't worry. What is the new thing you are going to learn which you have not learned in intermediate syllabus? Other comprehensive income, because my intermediate was over after that line. But IFRS requires that companies must disclose other comprehensive income also. What is the difference between profit and loss part 1 and other comprehensive income in part 2? Other comprehensive income are unintentional income or expense. Unintentional. That means management does not put its time, energy, effort, planning to earn this income, but because these are income or these are expense, I need to bring it at one place so that we can calculate the total income or total expense for the period. Earlier this item used to be directly adjusted in reserve. In intermediate, suppose there is a revaluation of fixed asset. So what we used to do, we used to directly write revaluation reserve in reserve and surplus, not routing through statement of profit and loss. But now you'll have to route it through statement of profit and loss by showing it separately. Let the user understand why the company's net worth has increased, because change in income will change the net worth. Change in income will change the net worth. So by highlighting it on the face of the statement of profit and loss, we get more clarity as to why the net worth of the company is changing. Is it right? Same thing in intermediate, we were writing directly in the reserve and surplus, most of the item. This also is divided into two types. Which two types? Those items which will not be reclassified to P&L account. That means once they are realized or settled, they will not be transferred to P&L account, but they will transfer to other component of equity, like for example revaluation reserve. Once the asset is sold, it will not be transferred to revaluation reserve, will not be transferred to P&L account, but it will be transferred to general reserve. Okay. And income tax on this item, that also you have to present. Then items which will be classified to P&L account. Which will be classified means once it is realized, it will be transferred back to P&L account. Example, foreign exchange difference. Example, foreign exchange difference related to suppose foreign subsidiary. So till you hold the subsidiary, the exchange difference will come here. But once the subsidiary is sold, the accumulated exchange difference is recycled to profit and loss account and any income tax expense. So this total will give me total of other comprehensive income. And once I add the profit and loss plus other comprehensive income, what I get is called TCI, total comprehensive income. And this total comprehensive income is transferred to statement of changes in equity in the respective column. Profit will go to retained earning column, revaluation reserve will go to revaluation reserve column, forex reserve will go to foreign exchange reserve column, etc. And you are also required to disclose earning per share. Earning per share will be disclosed separately for continuing operation. There are two types of EPS, basic and diluted. Refer Ind AS 33, but not today. We'll discuss this after some time. But it is similar to your accounting standard 20 in your intermediate. with some changes also, of course. Both basic and diluted EPS you have to disclose. Then you have to also disclose EPS for discontinued operation, both basic and diluted, and you will also disclose the EPS for continuing and discontinued operation, basic and diluted. EPS is a very important number because the share price of the company is affected by the earning per share. So that is why there is a standard also. It is calculated as per Ind AS 33 and it is disclosed on the face of the P&L account. Immediately it will draw the attention of the users of financial statement that what is the EPS of this year, what was the EPS last year. You can compare it with some other companies also and you can understand the performance. So one student had asked earlier, sir, where is the extraordinary item? Under Ind AS, there is no extraordinary item. All items are ordinary item. At the most, some item can be shown as exceptional item. Then secondly, what about prior period items, sir? In intermediate we were taught prior period item. There is no prior period item. Then where will prior period item go? You have to do retrospective adjustment. Oh my God. So if you make mistake in earlier year, discovered in current year, you can't rectify current year P&L account. You have to go to that year to which the mistake relates and rectify and bring it to the current year. Is it right? So companies will have to be very careful now when they prepare financial statement because mistake means retrospective application. You can't just ignore by writing one line item in P&L account. So in intermediate under accounting standard we disclose it in the current year P&L account as a separate line item, but under Ind AS we'll have to do retrospective adjustment. Now another format which you have not learnt in intermediate is the statement of changes in equity, SOCIE. So in short we will call it SOCIE. Is it right? Now what is SOCIE? Here basically we will show share capital and reserve and surplus. Reserve and surplus basically will start with opening balance and reach the closing balance by adding, deducting whatever changes which have happened during the year, and it will be divided into several columns depending upon how many types of reserves do you have. Is it right? So it is not something extraordinary. We have done the same thing in intermediate also, but there was no specific format for reserve and surplus. We simply used to write one by one: general reserve, opening balance, add profit, less dividend, closing balance. Same thing here we have to do, but in a format. So don't worry, it is very easy. So what you will do, you will first prepare statement of changes in equity, name of the company for the year ended or period ended, rupees in. One is equity share capital, where you will write opening balance, any changes during the year, and closing balance. So changes means plus minus, fresh issue, add, buyback, less, bonus share, add, conversion of debenture into equity, add. And there are some disclosures also which I will tell you later. What are the disclosures to be given for equity share capital? This is a big format, other equity. Sir, do we have to remember all these columns? The answer is no. It is a format. If some reserves are not in your question, then there is no need to draw. As a student, usually 3, 4 or 5 reserves will appear in your question. So only those many columns you will draw, and you have to move from opening balance to closing balance. Right? That is the logic. But there are some special points, keep in mind. You will write balance at the beginning. If there is any change in accounting policy, which has retrospective application, which has retrospective application. For example, under Ind AS, if you change the accounting policy voluntarily, example, if you change the accounting policy voluntarily, always retrospective effect. In some cases, the standard will tell you whether you have to do retrospective or prospective. Is it right? But if you voluntarily change the accounting policy, always retrospective. So you have to see what will be the effect of the change in accounting policy from retrospective effect and adjust your opening balance. You have to do some working, find out how much would have been the opening balance of reserve if this accounting policy would have been applied from the beginning. So that is your change in accounting policy. Similarly, I just now told you, if there is a mistake or error or omission which we call prior period item, you have to do retrospective application, and because of that, how much will your reserve change? That you have to adjust in the opening balance. And after rectifying your prior period item and retrospective change in accounting policy, you will call restated balance at the beginning. So revised opening balance. It is called revised opening balance. And then you will prepare a P&L account, which we did discuss just now. From P&L account, you will transfer the total comprehensive income. Profit will be added to profit. Capital reserve will be added to capital reserve. General reserve will be added to general reserve. Revaluation reserve will be added to revaluation reserve. So whatever you have written in that total comprehensive income, column by column you will add in that particular column. If you have declared or paid any dividend, declared or paid, not proposed. Proposed dividend will come only after it is declared and paid. Only proposed dividend is not a liability, hence not accounted, only disclosed. But dividend declared or paid will be deducted from the reserve from which you have paid it. Usually it is paid from retained earning or general reserve. So deduct in that column. Then any transfer to retained earning. So company may have a policy of transferring 10% profit from P&L account to general reserve or from any other reserve to retained earning. So whatever is the inter-reserve transfer, minus in one column plus in another column. Understood? Any other change to be specified. Whatever any other item, for example, conversion of debenture into share or whatever, and then you will get the closing balance. This closing balance will be transferred to balance sheet by taking the total of all these reserve. So it will appear in the balance sheet as other equity. It will appear in the balance sheet as other equity. Is it right? Right now I am not discussing individual item. They will come in the respective standards also. Okay? Because you will not understand right now. What do you mean by transfer? Transfer means transfer from share application account to share capital account. Is it right? Transfer, just make a correction here. Transfer from, make it from share application to share capital. If there is a typing error, rectify. Once the shares are allotted, share application money will be reduced, share capital will be added. Then from share warrant to share capital, from revaluation reserve to general reserve, from retained earning to general reserve. So these are the example of transfer. Although not important anymore, dividend distribution tax is withdrawn. And I have not seen question also in the last 2-3 years on dividend distribution tax. But if suppose by mistake asked, what will you do? Just like you have deducted dividend, you deduct the dividend distribution tax also along with dividend. So not very important. just a passing remark if it is given. Now the question was, what is OCI, other comprehensive income? Why we need to present it separately? Other comprehensive income also affects my net worth. Is it right? Net worth is net asset. Asset minus liability is net worth or net asset. Our net worth changes due to two reasons. Net worth changes due to two reasons. One is when I bring more share capital. Am I right? If I issue shares, will the net worth increase? Yes. That is called capital change. That is called capital change. Increase in net asset due to bringing more capital or withdrawing capital. Buyback of share means your net worth will change. Another reason why net worth will change is due to profit or loss. That is called performance change. Now because of OCI, all your performance will appear on the statement of P&L account, whether it was intentional, which is P&L account, or whether it was unintentional, which is OCI. Is it right? So example of capital change is issue of share capital, share application money, share warrant, securities premium. They also increase my net asset, but that is not due to performance of the company. That is due to raising of capital. And performance change example is profit and loss. The part 1 of the P&L account is intended profit. The objective was to earn profit. Management had put their time, energy, effort, resource to earn this profit. Example, sale of goods, interest, like that. OCI is unintentional. We don't put our time, energy, effort, resource, management strategies, planning for earning OCI, but they are part of the business. If you are holding a land, its value will increase. So, okay. So who has decided what items will come in OCI? IASB will decide. It has already decided. In order to avoid confusion or different policies, they have logged these items. Okay. IASB says we are telling you these are the OCI item. No question. That means you cannot say, sir, no, I think it was intentional. Forget it. It will come in OCI only. Otherwise, half of the companies will show in P&L account, half will show in OCI, etc. So, in order to avoid multiple treatment, they have logged the items which will come in OCI. Okay. Who has done that? IASB. There are total 9 items. Now next is one good news. Ind AS and IFRS will have same items in OCI. Example of OCI item, revaluation reserve, which you know. So I have given such example which you already know, but in intermediate accounting standard we used to directly write in reserve and surplus. Here first we will present in OCI and then we will also present in statement of changes in equity, so that the users will get to know the total performance change, total change in net worth due to performance. So in order to keep you engaged, we are going to solve one question. Are you ready? Those who have the notes, we are going to solve in the notes only, because I have drawn the format for you. Do you have the blank format with you? Yes. This question is not from the study material. This question is designed for conceptual understanding. So if you only say that, so I want only study material, then lot of gaps are there in the study material. That means they have not explained with example certain thing. Understood? I am going to take study material question, but wherever I find there is a gap in the study material, they don't have sufficient example, I have added some more example there. So this is a concept problem. They may not ask in the exam. but that will help you to understand how the companies now present under OCI and P&L account. Are you ready? A Limited has share capital of rupees 10 lakh along with plant and machinery of rupees 10 lakh. So opening balance sheet has two items. On the liability side you have share capital, on the asset side you have one plant and machinery of 10 lakh. Understood? So this is my opening balance sheet. At the year end, plant and machinery were revalued upward by 1 lakh. So this will become 11 lakh. A Limited earned a profit of 50,000 in cash on the last day of the year. So this revaluation of plant and machinery will be shown in OCI, but this profit earned from your day-to-day operation will come in first part called profit and loss. To keep the matter simple, ignore taxation, prepare extract of financial statement as per accounting standard and as per Ind AS. So what we have done earlier under accounting standard and what we are going to do now under Ind AS. So this will give you a good comparison also. So those students who have got the notes, class student and online student, you can start writing in the notes. Other student will write in the notebook. If you don't have the notes, you will write in the notebook. Question number 1 from schedule 3 division 2 chapter. So first you understand case 1 under accounting standard. If you are a accounting standard student, which item will come here? Both will come from 50,000 and 1 lakh, or only 50,000 will come? Only 50,000. Revaluation reserve does not come in P&L account. It directly goes and sits in the reserve and surplus. So PAT will also be 50,000. And in balance sheet, directly that revaluation reserve I will put it in balance sheet. Share capital will come 10 lakh, right? Reserve and surplus retained earning, how much? 50,000. Directly revaluation reserve will come in balance sheet 1 lakh. We should have prepared reserve and surplus note also, but it's okay. So otherwise you can prepare one more working reserve and surplus. So the liability side will have 11 lakh 50,000. Asset side, non-current asset, PPE. How much will you write in PPE? 10 lakh plus 1 lakh, 11 lakh. Assume no depreciation, no taxation, and remaining 50,000 was earned in cash. The profit was earned in cash. So you will write current asset, cash and cash equivalent in 50,000. Take the total, it is telling. This is what you have done in accounting standard or up to intermediate stage. But now you are a final student, you are a grown-up kid. So the same thing, how it will appear under Ind AS case 2. One thing I have to write here, statement of profit and loss, in short SOPL. In the exam do not write short form, okay, but in the class to save time we can write. So here I am going to write other income. PAT will also be 50,000, but then I will have one more component in the statement of profit and loss, OCI. And what will come here? Revaluation reserve. How much? 1 lakh. So total OCI 1 lakh. 50,000 is profit, 1 lakh is OCI. Total of profit plus OCI, that is called total comprehensive income, TCI, will be 1,50,000. Understood? When we are going to solve questions, we are going to present like this only. We be very careful. And then we'll prepare one format called SOCIE. Write down the format heading SOCIE. Not printed in the book, write in the notebook. I think there is some typing issue, so I sincerely request you write in the notebook, SOCIE. Write in the notebook, no problem. SOCIE format will be, there are two ways you can present. You can present share capital separately, reserve item separately, but as a student you are allowed to put share capital also in this format. Okay, companies will not do that. So SOCIE, total 4 columns on the right side: share capital, retained earning, revaluation reserve, and total. Everybody write in the notebook. Write in the notebook. Opening balance is given in the first line of the question. Opening balance is given. Opening balance, we have only one item, share capital 10 lakh. Is it right? Share capital 10 lakh. Then write add total comprehensive income. Add total comprehensive income. Add total comprehensive income. Now go to your statement of profit and loss. Profit is 50,000, correct? Revaluation reserve is 1 lakh, total 1,50,000, and then you take the total of each column also. 10 lakh in the first column, 50,000, 1 lakh, and total is 11,50,000. Now how will you present this in the balance sheet? 10 lakh I will present as share capital, and these two together I will present as other equity. Okay, below this write down one more thing, balance sheet. In your notebook write down balance sheet. In the notebook, keep the notebook with you. Write there question number 1, page number, reference write down. Your notebook is very important for exam. Notebook plus our class note, if you do it thoroughly, I think it will be very good, very sufficient material for you. You have to trust me. We have taken lot of efforts to prepare these notes. So now in the schedule 3 division 2, it starts from asset side. Okay, whereas in schedule 3 division 1, it starts from equity and liabilities. That is also one important care you have to take. So first you will write assets, non-current asset, PP. PP will be same 11 lakh. Current asset, cash and cash equivalent. Cash and cash equivalent. Cash and cash equivalent will be how much? 50,000. Cash and cash equivalent will be 50,000. Total 11,50,000. 11,50,000. This is your asset side. Now write down equity and liabilities. Equity and liabilities will have two items. One, share capital 10 lakh, and other equity will write. Other equity will be 1,50,000. Total 11,50,000. So can you see the balance sheet format is also different under Ind AS? Is it right? Balance sheet format is also different. Any query on the question number 1? Can we go to question number 2 now? We'll take a little more advanced version of this. You should have first feel the chapter. Okay, that how the numbers are presented in different formats, because this SOCIE may be something new for you. Probably you may not have done before this, probably. So one more practice I will take. This is also a concept question. A Limited had started the year with the following: share capital is 10 lakh, share application money is 5 lakh, retained earning is 4 lakh, general reserve is 2 lakh, revaluation reserve is 1 lakh, then PP is 20 lakh, and opening cash, this is opening cash 2 lakh. Understood? Just check whether the balance sheet is tallying. These are the equity and liabilities item, 22 lakhs, and these two are your asset side item, 22 lakh. Okay. During the year, sales were rupees 50 lakh, expense were 40 lakh. So these two will come in the first part of the profit and statement of profit and loss. Dividend paid was 35,000. This I will deduct directly in SOCIE. It was found that expense of 30,000 for previous year were still to be recorded. This is prior period item. So I will have to rectify the opening balance of reserve. This is the opening balance of reserve, retained earning. It is wrong, because had we booked the expense in the earlier year, my opening balance would have been lower and my balance sheet would have a liability item, expense outstanding. Balance sheet will have an outstanding item. So we will have to pass an entry, profit and loss to outstanding expense 30,000, and this profit and loss will be opening profit and loss, which we are going to reduce rather than showing in the current year profit and loss. If you are an accounting standard student, it will appear in the current year profit and loss as a separate line item, prior period expense. But now you have to adjust the opening balance of the P&L account. It is the policy of the company to transfer 1 lakh to general reserve per annum. So I am going to deduct from retained earning and add in the general reserve in SOCIE. PPE was again revalued downward by 40,000. Now you go to the opening balance. You have a revaluation reserve here, 1 lakh. Is it right? So we are going to reduce directly in the SOCI. We will also show in the OCI also, but we are not going to put it in the P&L account, because I already have an opening balance in revaluation reserve. So when I have a balance in revaluation reserve, first I utilize that in case of downward revaluation. Is it right? If it is revalued for downward for the first time, then it is adjusted in profit and loss. So what is your question? All the transactions were in cash except previous year expense which were not recorded. So I will create a liability in the balance sheet for that 30,000 rupees. Fresh issue of share 8 lakh. Using share application money 5 lakh. So 5 lakh you will transfer from share application money to share capital, and remaining 3 lakh will be received in cash. Yes or no? Bank account debit 3 lakh. Share application account debit 5 lakh. To share capital account 8 lakh. Prepare extract of financial statement, ignore taxation. Because right now you don't know about deferred taxation, etc. So we'll try to avoid taxation in this chapter except in 1 or 2 questions. So first I am going to prepare statement of profit and loss current year. Do you have the format in your book? So student who have got our class notes, I have drawn the format to save our time. Syllabus is very vast, so wherever possible I will give you the format, but I will also make you solve questions in the notebook also. Okay. And all these questions you have to today after going home, or those who are at home will revise and come tomorrow, because tomorrow we are going to take question which will run into multiple pages. Question will run into multiple pages, and those are exam questions. So let us write down. First, revenue from operations. Sales, write down 50 lakh. Question in front of you. Total 50 lakh, because there is no other income. Then write down expenses. Other expenses 40 lakh. That previous year expense will not come here. Tax is not there. So directly PAT will be 10 lakh. Other comprehensive income. There you will write decline in revaluation reserve. Bracket write 40,000. In bracket 40,000. Total OCI 40,000. This is 10 lakh. This is 40,000. So what will be TCI? TCI write down 9 lakh 60,000. Very good. Amazing. These are just questions designed for conceptual understanding. Now we'll prepare SOCIE. Okay. Is the format in your book ready? Yes. So first you start with opening balance. Go to question. Search for share capital. How much? 10 lakh. Application money 5 lakh. Retained earning 4 lakh. General reserve 2 lakh. Revaluation reserve total 22 lakh. Then we have to make one rectification of error. Point number B, rectification of error. In retained earning reduce 30,000. Because of the mistake committed in previous year, I have to do retrospective adjustment. So total is 30,000. Then below that point C, revised opening balance. Share capital 10 lakh, application money 5 lakh, retained earning will be 3,70,000, general reserve 2 lakh, revaluation reserve total 21,70,000. Point number D, total comprehensive income. Now you go to statement of profit and loss. What was the profit for the year part 1 before OCI? 10 lakh. And what was the revaluation reserve adjustment there? 40,000 negative. Is right, 40,000 negative. So you have to present here also. So total comprehensive income 9 lakh 60,000. Do we have any other adjustment? Yes, issue of share. Share capital will increase by 8 lakh. Out of 8 lakh, 5 lakh was transferred from share application money and 3 lakh was in cash. That I will add in cash in balance sheet. 3 lakh cash which we got will be added to the cash and bank balance in balance sheet. So my net effect is 3 lakh here. Then we have paid dividend also. How much dividend did we pay? From retained earning reduce 35,000. 35,000. This will reduce my cash balance. So when you prepare balance sheet, 35,000 will be reduced from cash balance. Now you write down transfer to general reserve. There is one more adjustment. How much amount is transferred to general reserve? From where? Retained earning 1 lakh. To where? General reserve. Net effect 0. Any more adjustment here? Read the problem. Any more adjustment here? No. So now you are ready to write the closing balance. So what is share capital finally? 18 lakh. Share application money 0. Retained earning 12,35,000. Very good. General reserve 3 lakh. Revaluation reserve 60,000. And total 33,95,000. Just check. You have to ensure vertical and horizontal total both match. Vertical and horizontal total. Very good. It is matching. Just before going to the balance sheet, this you will present as share capital in the balance sheet, and the total of these three items you will present as other equity. Okay. So now write down balance sheet. Now write down balance sheet. You will start from asset side or liability side? Yes, under Ind AS we will start from asset side. So go to your opening balance sheet given in question. You had one PPE item, yes or no? So first write down the heading 1, non-current asset. Under that PPE, nothing is given except that it was revalued downward by 40,000. Depreciation is not given. Ignore. 20 lakh minus 40,000. Yes, students, come on. 19 lakh 60,000. Very good. Current asset. Cash and cash equivalent. What is opening balance? 2 lakh. What is the sales minus expense? 10 lakh. Plus 3 lakh issue of share. Minus 35,000 dividend paid. This is dividend paid. Any student who wants to ask a query, this is issue of share. And this is cash profit. Sales minus cash expense. And this is opening balance, in case if you have not understood. Okay, so what is the answer? 14,65,000. Total of asset side. Is it tallying now? Yes. Is it tallying? 3425 25000. 3425 So this is how, this was a very basic question. We'll take one big question also, but first we should learn small simple questions. It is like learning car driving. First they will take you to a ground where there is nobody, okay, and after 2 days they will take you to the main road, then last 3 days they will take you to highway also. So this is right now we are walking on a or driving on a empty ground or a place where there is nobody. So that was my asset side. Now write down part B, equity and liabilities. Share capital 18 lakh. Other equity will be 12,35,000 plus 3 lakh plus 60,000. 15,95,000. Point 2, write down current liabilities. Under that, trade payable in bracket expense payable. Trade payable in bracket expense payable. That was 30,000. It is not yet paid. If it was also paid, you will write, you will deduct it from cash. Total should match. 34,25,000. That is the power of double accounting, double entry system. This was my question number 2, just a warm-up question. Some more discussion on OCI. Other comprehensive income is divided into 2 parts. Which 2 parts? Item which will not be reclassified or recycled, which means they will not be transferred to P&L account even if the asset is realized or the liability is settled. Okay, like even if the PP is sold, the balance in revaluation reserve will not be transferred to P&L account. It will be transferred to general reserve. So which are the items here? Which are the items here? One is revaluation reserve, also called revaluation surplus, which we are going to discuss in Ind AS 16. Okay. Then fair value change, gain or loss on investment in equity. Suppose you have investment in equity share capital of other company and you have decided to designate it as FVT OCI. Can you tell me the full form of FVT OCI? FVT. If there is a spelling error, rectify. So what is FVT OCI? Fair value through other comprehensive income. FV means fair value, T means through, which means whenever there is a change in fair value, that fair value will be routed through other comprehensive income. And even if that equity investment is later on sold, you are not going to transfer the balance to P&L account, you will transfer it to other component of equity, means other reserve item, but not to P&L account. More about this instrument we will discuss in Ind AS 109. Then some more discussion, but not in detail right now. Third item is fair value changes. Fair value changes, gain or loss on financial liability arising due to own credit risk. Arising due to own credit risk. That means your liability changes because of a change in credit risk. That change in the fair value will also be presented in OCI non-recyclable. Where will you study about it? Ind AS 109. And then one more, fourth item, consolidated adjustment. Like for example, interesting thing, understand, suppose you have an associate or a joint venture. Associate means companies where you have significant influence, where you are holding between 20 to 50%, generally, not necessarily. So you have to add their OCI item in your OCI to the extent of your share. So if suppose your associate has any OCI item which is non-recyclable, you will add in your OCI non-recyclable. Is it right? If your joint venture have any OCI item non-recyclable 1 lakh, your share is 20%. So 20,000 in consolidated financial statement you will add in your OCI non-recyclable. Okay. So this I am going to discuss in consolidation standard Ind AS 28. And fifth important item, tick mark, on which we have a question also in this chapter coming soon, is remeasurement of defined benefit plan. Defined benefit plan means something like gratuity, pension. Companies have to make provision for gratuity. They have to estimate it. But what happens? As it is an estimation, the value keeps on changing. So that change in the value will be routed through OCI item under the head non-recyclable. More about defined benefit plan we will discuss in Ind AS 19. Example, if you want to understand gratuity, pension, where the company is obliged to pay what they have promised to the employee when he will retire, and it is estimated by actuary and the valuation keeps changing. Second type of OCI item is recyclable, or which will be reclassified to P&L account. What are the examples here? One is exchange difference on translation of foreign operation, covered by Ind AS 21. So if you have a foreign subsidiary, foreign associate, foreign joint venture, till they are sold, disposed, exchange difference will be taken in OCI, and once they are disposed, this will be transferred back to profit and loss. Then gain or loss on cash flow hedge under Ind AS 109. Right now I cannot explain what is cash flow hedge, it will require one full lecture. Okay. Then fair value change on debt, underline debt. If it is a debt instrument designated as FVT OCI, it will be in reclassification. It will be reclassified. But if it is equity instrument, then it is not reclassified. Debt is reclassified, equity is not reclassified. More about that in Ind AS 109. Today is not the day for discussion of Ind AS 109. And point number 4 is same, consolidation adjustments. If you have an associate, and the associate is showing in their OCI item some reclassified item which are reclassifiable, our share in that will be shown in consolidated financial statement under OCI under item which are recyclable. Is it right? So these are the 9 items. For your interview also remember these 9 items. Or even in your audit paper also sometimes they ask such questions. I am not an audit teacher, but I have seen some paper where there is a question on OCI also. Okay. So 5 items are non-recyclable, 4 items are recyclable. Okay. Today as a homework you will read this whole chapter once again and come tomorrow, but today's lecture is not yet over. Okay. Now I will give you one example of non-recyclable item. Come to question number 3. A plant whose book value is rupees 10 lakh was revalued upward in 2019-20 by 1 lakh rupees. Okay. So where will that 1 lakh be shown? Revaluation reserve, OCI, non-recyclable. But this plant was sold in 2021-22 at rupees 12,50,000. So how much profit you will make on sale? 12,50,000, but the book value is 11 lakh because you have already increased by 1 lakh. So 1 lakh is profit on sale, 1,50,000. This 1,50,000 profit on sale will go to P&L account. It is not a revaluation reserve, and this 1 lakh will go to revaluation reserve OCI, and the year in which you are going to sell, the balance lying in that 1 lakh rupees will be recycled from revaluation reserve to general reserve or any other component of equity or any free reserve, but not to P&L account. So this question is 2019-20 is 1 year, 2021 is another year, but no event has happened in that year, and then 21-22. So 3 years are involved here. Can you see that? 3 years are involved. Prepare extract of the financial statement and also pass journal entries. So journal entries are always the best way to understand accounting. Is it right? The conceptual understanding comes from journal entries. So student will write in their, I think, book. I have drawn the format. These are basic concept question. Okay, not from ICI material. But this will make your concept very strong. Fundamentals must be right, then you can handle different type of situation. So first entry I will pass in 2019-20. 2019-20. What is the entry you will write? PPE account debit to revaluation reserve 1 lakh. Is it right? Now write down being PP revalued. Then 21-22 directly you have sold your PP for what amount? 12,50,000, and the book value is 11 lakh right now. Book value is 11 lakh right now. So therefore, gain on sale you will show 1,50,000. But there is a balance lying in your revaluation reserve. Once the asset is sold, balance in revaluation reserve is transferred to other component of equity. The standard does not tell you name of any particular reserve. So you can transfer it to retained profit, you can transfer it to general reserve. So write down to other component of equity. To other component of equity, yes, Mr. Rahul Sundar, any answer? 1 lakh. And then I have written a note for you. Don't write, printed in the big book. Revaluation reserve cannot be recycled but will be transferred to other component of equity, which means it cannot be routed through P&L account. Now we'll prepare statement of profit and loss. I have drawn 3 columns here. Okay, there are 2 parts here. Part A is the profit and loss part, part B is the OCI part. So gain on sale will come in which year? 21-22. And what amount you will write there? 1,50,000. Then point B, item which cannot be recycled, revaluation reserve 1 lakh will come in which year? 1920. 1 lakh. 1920 will write 1 lakh. And that 1 lakh in the SOCIE in the third year I will transfer to other component of equity. Is it right? Is everybody paying attention? Okay. So now you will prepare SOCIE one below the other, year 1, year 2, year 3. Is it right? So SOCIE 1920. Opening balance is not there. Total comprehensive income. So opening balance you can just put dash dash dash. Total comprehensive income is 1 lakh. Is it there 1 lakh? So my total will be 1 lakh, 1 lakh. This is the presentation of SOCIE for the first year. Okay. Then below that I have written 2020-21 opening balance 1 lakh in revaluation reserve. Total comprehensive income nothing is given. 0, 0, 0. Therefore total is again same. Just to check your confidence, second year they have not given anything. So you are getting 1 lakh. Okay. Below that I have written 21-22. Opening balance 1 lakh. Now understand, total comprehensive income in retained profit, go to your P&L account third year. In P&L account third year, how much was your profit on sale? So that will come here. And one more line item I will add, transfer from revaluation reserve. Because now the asset is sold, I will not keep the balance in revaluation reserve. This we are going to learn in Ind AS 16 also. But you have studied a similar standard AS 10 in accounting standard, where also we had same adjustment. Once the asset is sold, you will not keep the balance in revaluation reserve. You will transfer it to other component of equity. So we have decided to transfer it to retained earning. Retained earning 1 lakh, revaluation 1 lakh, total 0, and then take the vertical total. Yes, Mr. Hari, vertical total of first column 2,50,000, second column 0, third column 2,50,000. Okay, this is how the presentation will be done. Now one more paragraph I have added from my side, not in the study material. Journal entries for OCI items. Journal entry for OCI item, and you will see I have divided into 2 columns. The first column is items which cannot be recycled. Example, revaluation reserve. Just now we have seen. And second type is items which can be recycled. Example also we have discussed, gain on investment in debt instrument designated as FVT OCI. Gain on investment in debt instrument designated as FVT OCI. So first you focus in that non-recyclable item. If there is a revaluation gain, for example, it can be any other item. I have taken the example of PP because you have done questions on PP in accounting standard also, and there are a lot of similarities between accounting standard 10 and Ind AS 16. So when the PP will be revalued upward, we'll pass the entry PP account debit to revaluation surplus. This I am going to present in OCI, and plus I am also going to present in SOCIE. In the year in which the PP will be sold or de-recognized, I will transfer from revaluation reserve to other component of equity, which we did in the question number 3, being revaluation surplus transferred. But suppose the item is of this type, which are recyclable to P&L account. First entry will be, say, investment in debt instrument classified as FVT OCI, debit to fair value gain on debt OCI. Same thing, you will present in OCI under recyclable item which can be reclassified. Okay, and you will also present in SOCI. You will open one column where you will write fair value gain on debt instrument classified as FVT OCI, and there you will write the amount. Then in the year in which you are going to sell that debt instrument, whatever is the balance lying in OCI will be recycled to P&L account. So fair value gain will be debited to profit and loss account, and in your P&L account you will present one line item reclassification gain. In P&L account under other income or below other income you will write reclassification gain, and then OCI will be debited in P&L account, and even in SOCI you will remove it. In SOCI also you will remove it. So I am going to show you how to do the presentation of OCI which are recyclable and which are non-recyclable in the same problem. Again, write down concept problem. So these are the 4 concept questions I will take, and after that we will take some exam questions also. Okay. These 4 questions you will not find in any publication of the institute, but because students don't understand OCI, we thought that we'll just go little slow today, first part of this lecture, where you have to understand how the presentation is done. Are you ready? A Limited has following assets: PPE rupees 5 lakh, investment in equity instrument classified as FVTPL. What is the full form of FVTPL? Fair value through P&L account. It means these are those investment in equity share. When the fair value will change, the change in fair value goes directly to P&L account. So no problem with that. Is it right? Here the intention of the management is to make profit by trading in those shares. That is why FVTPL. But in FVTOCA, the intention of the management is long-term investment, strategic investment, not to earn the profit by playing with the change in the market value of that. That is why they are called FVTOCI. So that will be any change in the fair value of this item will go to OCI. Any change in fair value of this item will go to P&L account. Any revaluation reserve of PPE will go to OCI. Understood? Now this is non-recyclable. This is already in P&L account, so no problem. And this is non-recyclable. Okay, understood? What is going in P&L account, the question of recycling does not arise only. There is nothing like from P&L account to OCI. Okay. Next point, at the end of the first year, market value of this asset increased by 40,000 for PPE, 10,000 for equity instrument classified as FVTPL, and 15,000 for equity instrument classified as FVT OCI. Tell me, where will this be shown? OCI non-recyclable. Where will this 10,000 be shown? P&L account. 15,000 OCI non-recyclable. In the second year, the PPE was sold for rupees 7 lakh. Now wait, opening balance is 5 lakh plus 40. So book value is 540. Sold for 7 lakh. Sold for 7 lakh. So in second year profit is 1,60,000. That is the profit on sale. Where will you transfer that? That will go to P&L account in second year. And this balance of 40 which is lying in revaluation reserve will be transferred to other component of equity. So that is the story of PPE. Investment in equity at FVTPL was sold for 120. Very easy. Opening is 90 here plus 10. 1 lakh is book value. Sold for 120. So 20,000. Where will you show? Again P&L account, because it is FVTPL. And investment in equity at FVTPI was sold for 1 lakh. So first you check book value. This is 80,000 plus 15. So 5,000. This 5,000 OCI will remain in OCI. It doesn't go to P&L account. As per Ind AS 109. If there is any FVT OCI equity instrument, it never goes to P&L account. So it will be shown in OCI only. It will be shown in OCI because it's a strategic investment. Okay. And once you sell it, whatever is the balance lying in that account will be recycled to other component of equity. Is it right? So total balance lying in OCI account for equity instrument designated as FVT OCI will be 20. Why 20? 15 here plus 5. So first I will take 15 plus 5, 20, and then 20 will be transferred to other component of equity. More about this FVTPL, FVT OCI I will explain in Ind AS 109. Then question is prepare extract of P&L account, SOCI in balance sheet. So a very good question for conceptual understanding. They should have added one recyclable item also. Okay. Anyway, don't be so greedy. Is the format drawn in your book? Yes. So please trust me, your syllabus is quite vast. Equal to 2 direct tax subject. Okay, 1 FR is equal to 2 direct tax subject. So we need to really work hard and fast also. So tell me, if I ask you to do fill in the blanks, will you be able to do? Try. First you will try, use a pencil. Okay, I request you to bring a pencil. Your book should look neat and clean. Bring an eraser also. Because when you will revise before the exam, you should not be confused. Okay. So first you try. I have given the format. I am sure you can do it. 5 minutes, not 5 minutes is too much. 1 minute you will take. 1 minute starts now. Okay, you will try first. Go year by year. First complete year 1, okay? Then complete year 2. Check what happened in year 1. Check what happened in year 1. Use a pencil if possible. Use a pencil and you can erase it in case if you go wrong. There is no harm in making mistake. Yes, Mr. Hari, are you trying? Mr. Rahul, are you trying? Only complete P&L account first. Done? Okay. So we will check the answer. First is other income. Under other income, we have fair value change in equity designated at FVTPL. So first is 10,000. Then gain on sale of PP will come in second year. Gain on sale of investment will come in second year. Then revaluation reserve 40,000 you have written and 15,000 in equity designated at FVT OCI. Total other comprehensive income 55,000. So how much was your TCI of the first year? 65. Let us try the year 2. Gain on sale of PP 1,60,000. Gain on sale of FVTPL equity instrument. Is it 20,000? The basic calculation you should be able to solve. So therefore the total is 1,80,000. Is there any revaluation reserve in second year? No. But is there any gain on equity instrument? Yes, that will come in OCI only as per Ind AS 109. So for the time being you have to trust me because you don't know Ind AS 109. So total is 5,000 and then the total comprehensive income is 1,85,000. So in the first year you are going to add this 10,000, this 40 and this 15 in the respective column. Then in second year you are going to add this 160, this 20 and this 5 in the second column. And because you have sold the PPE, you have sold the FVT OCI equity instrument, the balance will be recycled to other component of equity. So now you come to SOCI year 1. Very, very important. Many students ignore basics. Some student I have seen they directly practice from some kind of question answer book only. You can't do that. You can do question answer book, no harm in that, but first you have to clear your concepts. And in question answer book, the question comes in any sequence because they simply copy paste from MTP, RTP in any sequence they come. So that is not a good way. Our book is arranged in a sequence, concept wise. Okay, try this one. Opening balance. Is it given opening balance? Nothing is given, so just ignore. Total comprehensive income. Go to the first year. Go to the first year, start from the second line. Gain on sale of, how much was that? 10,000. Yes. Then revaluation reserve somewhere below 40. And equity instrument through OCI 15 total. So now you write down closing balance. Don't get bored. You have to write 10,000, 40,000, 15,000, 65. Some student don't write total or closing balance. You have to write opening plus minus closing. If you want full marks, then write full. If you want half, write half. Simple equation. Year 2 again write opening balance at the cost of repetition. 10,000, 40,000, 15,000, 65,000 and then you write transfer from revaluation reserve to retained earning. So once you have sold the PP item, you put 40,000 negative in revaluation reserve column and 40,000 positive in retained earning column, and then total comprehensive income. Go to the second year in P&L account. From the top you see somewhere you have written 1,60,000 and 20,000. So both 160 plus 20, 180 will come in the retained earning. You don't have to write separately. There is nothing in revaluation. OCI is there 5,000. Total 185. It should match with your last line of P&L account or statement of profit and loss. This total will now be recycled within the SOCI, not through P&L account. That is the instruction given by the IFRS. Okay, we can't change it. Like it or don't like it. There is no option here. So 20,000 you put minus in OCI column, equity instrument, and 20,000 you add in retained earning. The standard does not tell you name of the reserve to which you have to transfer. Is it right? In India we have so many varieties of reserve. Capital reserve, general reserve. Okay. But in foreign countries they don't have so many varieties of reserve. They don't understand also sometimes. Investment allowance reserve used to be there. Development rebate reserve. Now most of these have gone, but still some of them still exist. So now final total is 250, 0, 0 and 250, sorry, typing mistake, 2,50,000 here. Got it? Now prepare balance sheet. Balance sheet extract, write down. First you write here non-current asset side. Non-current assets. Under that write down PPE. In first year PP will be 5 lakh plus 40,000. Is it 5 lakh 40,000? Anybody? Second year? We have sold. We have sold. So the answer is 0. Then write down investment in equity FVTPL. FVTPL. First year it will be 90 plus 10, 1 lakh. Second year 0 because it is sold. Then write down investment in equity FVTOCI. FVTOCI 80,000 plus 15, 95. What about second year? All these three assets are sold. So balance is 0 in the second year. Okay. Now I have not written this properly. This should come under current asset. Because it is FVTPL, the intention itself is to trade and make profit out of it. Is it right? Anyway, I will discuss current, non-current in schedule 3 that I have not yet discussed. Now some notes I have written for you, because you may have a doubt that why profit on sale of PPE we have transferred to P&L account, but profit on sale of equity instrument classified as FVTOCI we have not transferred to P&L account. So write down the, I think I have given you the notes in typing only. It will save our time. Gain on sale of PP is transferred to P&L account because as per Ind AS 16 we have to do that. But gain on investment in equity at FVTOCI is not transferred to P&L account. All gains are kept in OCI only as per Ind AS 109. Second thing is we also have to show the tax on OCI item. Okay, even though it is not payable as per the law, because there is concept of deferred tax. If you are showing income then you have to create a deferred tax liability also on that. But because in the question it was not given, we have ignored it. But I will take one question of deferred tax also later. In the given example, we should have created deferred tax liability. Don't worry, right now we will not discuss. And similarly, if there is a loss, then we are going to create deferred tax asset also. If you are gaining but not paying tax, means your tax liability is only getting postponed. And if you are having loss, you are not able to get the benefit today, but you will get the benefit at a future date, and therefore it gives rise to deferred tax asset. More about that in Ind AS 12. Now quickly we will discuss explanation of items of profit and loss. Very quickly, you already know most of it. Nothing great. As far as students are concerned, they don't ask such a minute detailed question, okay, but you should know it. You are a potential CA. Revenue from operation. Revenue from operation means you have to disclose your revenue from primary business operation of the entity. Revenue from primary business operation of the entity. You will disclose your sale. You can also disclose any incidental income relating to primary operation, like sale of scrap also, because some companies have huge revenue from sale of scrap, like Tata Steel. Then what about GST? Underline, the revenue is shown net of GST. GST is not included in revenue. GST is not included in revenue. It is not your revenue. It is whose revenue? Government revenue. So you have to collect from the customer and pay to the government. So it's not your revenue. Earlier, long back, before Ind AS, before Schedule 3, when there was a Schedule 6 under Companies Act 1956, and that time the tax rates were also very high. So companies used to show in revenue the indirect tax collected from customer also, and they used to project a huge revenue. But out of that, 30-40% was only tax collected on behalf of government. So now they have clarified. Revenue is net of GST, but excise duty is included in revenue. Excise duty? Do we still have excise duty? On very few items like petrol, but we don't get a question on excise duty anymore, so enjoy. The reason is GST is also not treated as an expense. Excise duty is treated as manufacturing expense. For example, excise duty is applicable on petrol. I think they are planning to remove that also. Whether they have removed it or not, I am not very much sure, but not yet. And then what about other income? So whatever you don't fit into revenue from operation, you will write in other income. Of course, if you think it is an exceptional item, then instead of putting it in other income, you can put it in exceptional item also. Okay. So income which are not intended but are from, intended but not from primary operation. Like for example, in case of Reliance balance sheet, you have interest income because they have so much of investment. So they are investing, management is putting their time, energy on that, but the primary business is not interest generating activity. So dividend income, because companies invest their surplus money in shares, mutual fund, bonds, PPF, not PPF, sorry, FD, other corporate bonds and debenture. So that will come. Then profit on sale of PP, profit or loss on sale of PP, that you can also put it under exceptional item, but don't put at both the places. And then if you have got any GST refund, you can put it here. Then just now we discussed one item, reclassification adjustment. Reclassification adjustment means from OCI to P&L account. From OCI to P&L account. That will also come here. Next is material consumption. In expense side, we have first item material consumption. So what will be material consumption? Material consumption will be opening raw material plus purchase of raw material minus closing stock of raw material. Then purchase of stock in trade means purchase of finished goods. There is an item purchase of stock in trade in P&L account. What you manufacture will come under raw material consumed. What you only do trading will come under purchase of stock in trade, and change in the stock means opening finished stock, opening finished stock, and actually opening stock in trade also, finished stock and stock in trade minus closing finished stock and stock in trade. For the closing stock valuation, we will apply the standard Ind AS 2, which is very similar to, not 100% similar, but very similar to accounting standard 2. That has not yet been upgraded so much. So they have continued with the same Ind AS 2 for a very long time. But there are some differences. So the basic rule of the game is cost or NRV, whichever is lower. And under employee benefit expense, we have items like salary to employees, even directors' sitting fees will come here, all retirement benefits will come here, bonus will come, even that ESOP benefit will come here. Okay. Then under financial expense, we will have interest calculated using effective interest method, which we are going to discuss in Ind AS 109. Effective interest method means IRR. The whole accounting of interest will undergo a change now, because we don't transfer coupon interest to P&L account, rather we transfer effective interest to P&L account. Coupon interest is only a payment made to the investor or the bondholder. What goes to the P&L account is the effective interest that you are paying on your debt securities. And then we will show depreciation and amortization on both tangible and intangible asset. And then finally we have other expense in P&L account, which is like a residual category. If it doesn't fit into above category, then you put everything in other expense. Okay. And these expenses should be disaggregated and disclosed. Where will you disclose? You will make a note. In that notes you are going to write down the breakup of other expense like printing and stationery, auditors fees, okay, CSR expenditure, all these are shown separately, mandatorily. Auditor fees irrespective of the amount, show separately. CSR expenditure, show separately. As per Companies Act Schedule 3, if any item of expense exceeds a specified limit, which is right now rupees 10 lakh or 1% of turnover, whichever is higher, will also be separately disclosed. Then we have extraordinary item, not applicable. Exceptional item will be disclosed as per Ind AS 1 if the management thinks that disclosure is important for this item, useful for future projection of profitability of the company and understanding the current year performance also. Okay. Then example of extraordinary items are decline in value of inventory. Now student had a query here, decline in value of inventory, will I write in the change in the inventory or exceptional item? At one place you have to show. If you are showing the decline in the change in inventory, then don't write it here. But if you think the amount is significant, okay, a book publisher had printed lakhs of books of CA final course, suddenly the course changed and 80% of their inventory is now obsolete. So for them it will become an exceptional item because the cost was 300 rupees, now they will have to sell it for 5 rupees per kg. Who is going to buy outdated syllabus? Are you going to pay even 300 rupees for that? No. So then it is an exceptional item. Show it here. Gain on sale of investment, provision for restructuring, reversal of provision, gain on sale of PPE. Okay. These items can be shown in other income and other expense also, but if the management thinks that they need to be disclosed separately, then they can put it in exceptional item. What about tax expense? As you know, we have to present two types of taxation: current tax, which is the tax payable as per the tax law. Current tax is actually paid to the government, but deferred tax is an accounting adjustment. It is not paid to the government. It is to ensure that our profit does not fluctuate too much. Otherwise, what happens in 1 year, you show very low tax liability because you will pay tax in future year, and in other year you show a very high tax liability because that item resulted into profit and you paid tax. So there will be huge fluctuation in the PAT figure just because of treatment which is different in accountancy and difference in taxation. Like for example, if you revalue a land upward, is it right? So you will increase in the books of account, but you are not going to pay tax now. When are you going to pay tax? When you sell it. When you sell it. So books will show income now, that revaluation reserve, or simple example, equity instrument at FVTPL. You increase the value by 10 crore rupees in the books because the market price has gone up, but you don't pay tax. So this year your profit will be high. Next year when you will sell, you have to pay more tax because your book value, your value for income tax is still the same. So next year your tax liability will be more, PAT will be lower. So 1 year high PAT, second year low PAT. So deferred tax is a shock absorber. Deferred tax is a shock absorber. Deferred tax is a profit smoothing exercise. They have asked in the interview also why deferred tax is required. Even though you have learned the entire Ind AS 12, but the basic question why it is required: to smoothen your profit figures. So deferred tax is calculated. We have to see whether because of this adjustment we will have future tax advantage or future tax disadvantage. If you are going to pay more tax in future, will create deferred tax liability, and if you are going to save tax in future, we are going to create deferred tax asset. More about deferred tax in the separate chapter in Ind AS 12. What about proposed dividend? Already you know, proposed dividend will not be accounted, but it will be disclosed in the notes. But when dividend is declared means properly declared. If it is an interim dividend, the directors will declare it, and then it becomes a liability of the company. And if it is a final dividend, it is declared by AGM. So the moment AGM declares the dividend, then it is accounted for. Only if it is proposed by the board is not a liability, because it can be reversed by the AGM. OCI, oh my god, already discussed earlier. Is it right? So OCI I am not repeating. 2 times we have already discussed. So this was about only P&L account and SOCIE. One more item is pending, that is balance sheet, and after that you have lot of disclosures also we have to see. So we will take a 5 minutes break. Please come fast. 5 minutes break only. I am not stopping the video. Okay, welcome back. We will now discuss the format of balance sheet. Today you will read the bare text of Schedule 3 Division 2, which is printed at the end of the chapter. Okay, and we have made a summary of that. All important points we will discuss today. So balance sheet, name of the company you will write, balance sheet as at you will write, and rupees in. According to question you can write in 1000, lakhs, million, crore, whatever they will write in the question you will do it. And this will be the format. This remark column I have added for explanation part. Remark is not a part of the format. Okay. So you have note number, end of current year, end of previous year. This balance sheet starts from asset side. This balance sheet starts from asset side. You will say, no sir, equity and liabilities, oh those days are over. Now you have become a big man. So one, non-current asset. Only two parts are there on the asset side, non-current asset, current asset. About what is current and non-current asset we will discuss in Ind AS 1. Is it right? But basic information you already have. Detailed discussion in Ind AS 1 as to what is current and what is non-current asset. So here we will disclose items, property, plant and equipment. Which items will come here? Example, factory, building, plant and machinery, furniture, office equipment, and one more item, bearer plants. The meaning of bearer plant will be discussed in Ind AS 41 and also Ind AS 16. Example of a bearer plant is a mango tree, that is those plant which bear fruits and vegetables. They themselves are not sold, but the produce is sold, like mango tree, and they have a long life. So therefore even the bearer plants are treated like PP. They are also depreciated, revalued and like that. Then next item is capital work in progress, which means those PPE item which are not yet ready for use. They are under construction, like building under construction, plant and machinery under construction. One more line item which was probably you have not studied in intermediate was investment property. There is a standard on that. Can you give me the number? Yes, number Ind AS 40. Investment property means investment in land and building for earning rent or capital appreciation, not for use in the business. Don't write, it will come in Ind AS 40. Main objective is to earn rent, capital appreciation, like investment in land, investment in real estate. Then next item you will disclose is separately goodwill. Then you have to disclose other intangible assets. Which standard deals with intangible asset? Any idea? Ind AS 38. And what are the examples of intangible asset? Brands, software, patents, trademark, website, copyright, license, mining rights, designs. These are intangible asset. Similarly, you have intangible asset under development. It takes long period of time for an intangible to be ready. For example, software. It may take 3 years, 5 years. Finally, a software will be launched. So that is intangible. You have to disclose it separately because funds are blocked. Sometimes funds are blocked for a very long period of time. So it is better to inform your investor users that so much money has already been invested in this intangible which is under development, and there are some disclosure requirement which I will tell you after some time. So examples are software under development, website under development, COVID medicine under development. One more new item for you is biological asset. Ind AS 41. Ind AS 41. Not applicable to many companies in India, but yes, for a few companies it is still applicable, like companies having tea plants, coffee plants, livestock will come here, plants other than bearer plants, because bearer plants will come as a separate item under PPE. Then after that we will disclose financial assets. There are 3 standards dealing with financial asset: Ind AS 32, 109, 107. Now how do you differentiate financial assets from other asset? In financial asset there is a contractual right to receive cash or other financial asset from other party, but I am not going into detailed discussion of this. We will discuss in Ind AS 32, 107, 109, contractual right to receive cash. Then investment. Under financial asset we will show investment. Investment in FVT OCI instrument separately disclosed. Investment in FVT PL. Investment at amortized cost. These are the 3 categories of financial asset as per Ind AS: FVTPL, FVT OCI and amortized cost. Similarly, if you have investment in subsidiary, associate, joint venture, it will be disclosed separately. Investment or then trade receivable. Oh, some student will wonder why trade receivable has come in non-current asset. Suppose your debtor will pay after 3 years. So don't you think it will come as non-current asset? You may have a agreement with the debtor that you can pay after 3 years. So debtors will come here, less allowance for bad debt. Any allowance for bad debt or what we call now impairment loss will be deducted. Then loans and advances, example loans given to staff, loan given to others, and other financial assets. Under other financial asset we have bank FD, but it should have a maturity of more than 1 year. What if it is a maturity of less than 12 months? Current. Deferred tax asset always non-current. Deferred tax asset always non-current. And then finally one last heading is other non-current asset. What will not fit specifically into the above heads, you will put it under other non-current asset. Example gold, silver, capital advance, that is building advance. Building advance is not a financial asset because here there is a contractual right to receive asset, not cash. So it is not a financial asset. What about gold and silver? Interestingly, there are no specific standard on gold and silver. Then the second part of the asset side is current asset. Under current asset you will start with inventory. Different types of inventory you will present separately, like raw material, WIP, finished goods, stock in trade, and then you will write financial asset. Under that you will write trade receivable if it is short term. Cash and cash equivalent, under that we will write cash in hand, cash at bank, bank FD whose maturity is 3 months. Bank FD whose maturity is 3 months from the date of acquisition will come under cash equivalent. Other items will come as other bank balance. For example, bank FD whose maturity is more than 3 months up to 12 months. Then earmarked deposit. Earmark deposit means those amounts which are for specific purpose. Like for example, when the company declares dividend, they transfer the amount to a special account from which dividend will be paid. Or margin money, that means sometime in order to get some contract or some job, you have to deposit some money with the bank, margin money. Loans and advances also will come here if it is short term, example loan to staff, loans to other, and then other financial asset. Under other financial asset we will show accrued interest, interest receivable, dividend receivable, etc. And then next item is current tax asset. Current tax asset means TDS. Somebody has deducted TDS, so we are going to adjust it against tax liability. We pay advance tax, any income tax refund receivable, and if you have a MAT credit. Have you heard MAT credit? Minimum alternate tax. In some year we pay tax as per MAT. That is when the tax liability as per book profit is more than tax liability as per normal provision of Income Tax Act. That is called tax paid as per MAT. So the excess amount paid as per MAT can be adjusted against future tax liability. So it is your asset. So it will be presented as a separate item in current tax asset. It is not shown as a financial asset because it is not contractual. It is statutory item, not a contractual item. You get this right because of law, not because of contract. And then in the last item you will put other current asset like advances paid to supplier, prepaid expense, then GST input credit will come under other current asset. So that was my asset side. Now we'll come to equity and liability side. Under equity and liability side, you will start with equity. Under that, first we'll write share capital. The detailed discussion we have already had, and we have to make a separate disclosure of all the paid up capital, authorized capital, etc. in SOCI. Change in share capital in SOCI. For other equity also we'll prepare one SOCI. Then if you are preparing CFS, consolidated financial statement, then non-controlling interest, which you know as minority interest, will also come under this heading, equity, because they are also equity shareholder of subsidiary company. Is it right? So we'll prepare one note on in SOCI. Then we will show non-current liabilities. Liability side has three items: equity, non-current liability, current liability. And non-current liability, first item financial liability. Under that, borrowing, example term loan. Then amount which is payable within 12 months will be shown as current liability. Suppose you have to pay loan in 5 installment. One installment is payable next year. So this one installment amount will go to current liability, and remaining 4 will come in non-current liability. Then trade payable. Now you have to divide the trade payable into two categories. Payable to MSME, micro, small, medium enterprise. Many companies don't pay as MSME, their money is getting blocked. So they have a liquidity problem. The big companies are enjoying, small companies are suffering. So they have asked that you must disclose separately on the face of the balance sheet, and there are some more disclosures here, we'll come to that, and trade payable others. And now they have to give aging also. Do you know aging? Up to 6 months, 6 months to 12 months, 12 months to 1 year, 1 to 2 year, so that as a user I will know that the company is delaying in making payment to the creditor. Delaying payment to creditor will affect the reputation of the company. Then next item is other financial liability. long term liabilities, that is contractual obligation to pay. Financial liability means contractual obligation to pay cash. Deferred tax liability as per Ind AS 12. However, if you are getting both DTA and DTL, as per Ind AS 12, it can be set off subject to certain condition. One condition is that DTA and DTL must arise under same tax law. DTA and DTL must arise under same tax law. Then in the balance sheet, I will show net figure. If liability is more than asset, net DTL. If asset is more than liability, net DTA. Then we'll come to next item, long-term provision. Under long-term provision, example could be retirement benefit liability, like provision for gratuity or provision for warranty. Then we have other non-current liability. So here we will write down those long-term liabilities which are not contractual. If it is contractual liability to pay cash, it will come under financial liabilities. And after that, the third item is current liabilities. In current liabilities, we have a financial liability. You will find same presentation for current liability. We have borrowing. It will have short-term borrowing, bank overdraft. Then trade payable will also come under financial liability, because there is a contractual obligation to pay cash. Divide into two categories, payable to MSME and other payable. Then after that we have other financial liabilities. Example, accrued interest, unclaimed dividend, bills payable, commercial paper. Commercial papers are short-term borrowing. Then after that we have current tax liability, where we will show tax payable to the government, actual tax payable to the government calculated as per tax law. And then all short-term provisions will come here, including provision for losses. And then other current liabilities which are contractual but not payable in cash. Is it right? Like for example, advance taken for supply of goods. So my contractual obligation is to deliver goods or service. So it will come under other current liability. So this is about balance sheet item. To make your task easier, I have written some notes also. While solving the question, we will take care of these notes. If the amount is due within 12 months from the end of the reporting date, like in case of loan, in case of lease liability, then what we will do, that portion of the liability which is payable within 12 months, we are going to put it under the head other financial liability under current liability. Why? Because current ratio will get affected. Current ratio tells you current asset divided by current liabilities. The persons who are interested in knowing the liquidity of the company will check the current ratio, and this liability will come within 12 months. So therefore, if you are interested in knowing the liquidity position, you need to know which liability will fall due within 12 months, and hence now whenever you have a liability whose some portion is payable within 12 months, that also you show it in the current liability. Very important ratio. Liquidity is very important factor. Otherwise, what will happen? What happened to Go First Air? Liquidity problem. What happened to Jet Airways? Liquidity problem. What is happening to SpiceJet? Liquidity problem. Okay. So if the investor knows well in advance this company is likely to have a liquidity problem, you will stay away from that company. MSME means micro, small and medium enterprises. Government is trying to protect them by making companies show the amount due to MSME separately on the balance sheet. So if the amount is due, overdue, it will bring disrepute to the company. Goodwill will get affected. Is it right? What about preference share capital? Oh my God. It can be either equity or liability depending upon the terms of the issue. So Ind AS 32 you have to refer for that purpose, and accordingly it will get classified. What about compound financial instrument like convertible debenture? Convertible debenture, convertible preference share are mixture of debt and equity. So the equity portion will come in equity and the liability portion will come in current or non-current liability as per Ind AS 32. What about derivatives? Derivative will also appear in the balance sheet now. If you have entered into forward, future, option swap, it will appear as an asset or a liability in the balance sheet under, if it is asset, it will come under investment. If it is liability, it will come under as current liability. Then what about contingent liability? Contingent liability is shown in the notes outside the balance sheet because we need to inform our users that these are our potential liabilities. Sometimes the amount can be too high, like it happened in Vodafone case. They have to pay 10,000 crore rupees to the government as contingent liability. If they lose the case, they pay 10,000 crore, company get wound up also. So lot of companies, recently I have heard lot of casino companies, gaming companies, they were paying or not paying GST. Now they have to pay GST at the rate 28%. And some of them have to pay 5,000, 10,000 crore rupees of GST liability. And if they lose the case, the company can be wound up because they may not have so much of assets also. Disclose it as a contingent liability and then the users can take a more informed decision. Now we'll come to the disclosure part quickly. Normally not asked in the exam. Normally not asked means never asked is not an appropriate term. Otherwise you will ignore it, and if they ask you, you will blame me. So I will read it. What are the disclosures to be given in the notes? For PP item, you have to disclose the class of asset. For example, plant, furniture, vehicle. You can't mix all of them. Computer. And you have to give a reconciliation starting from opening balance, addition, deduction, depreciation, closing balance. Same disclosures required for leased asset also. For leases, we have to also refer the disclosures given in Ind AS 116. Refer Ind AS 116. Capital WIP, you have to give a reconciliation from opening to closing, and the same thing for leased asset also. Investment property, same disclosures are required. Goodwill, you have to give disclosure relating to amortization. Then intangible asset, disclose the class of asset, disclose reconciliation, same disclosure required for leased asset. Intangible asset under development, you have to disclose the class of asset, whether it is software or patent or what. Then reconciliation is required for owned asset and disclosure is required for leased asset. Biological asset, write on biological assets like animals and plants. You have to disclose again class of asset, how many sheep, goat, cow, elephant, horses. Okay. Then reconciliation, refer Ind AS 41 for more detailed disclosure requirement. That time there is one page disclosure, I will tell you later. And disclosure is required for leased asset also. Then trade receivable, tick mark important, they have asked question on this and we are going to take those 3-4 questions. You have to give disclosures about trade receivable who are considered good and secured. Good but unsecured. The difference is here you own some security. You have some security. If it does not pay, you can recover from the security. Unsecured means God will help you if it does not pay. Trade receivable having significant increase in credit risk. That means those debtor where risk has gone up. If suppose customer is not paying for last 3 months, risk has gone up. If the insolvency proceedings have started against a customer, which means risk has gone up. Okay. And those creditors which have become credit impaired means they are bad. Recovery is very difficult. Disclose separately. And any allowance for bad and doubtful debt will be disclosed here only as a deduction. You also mention here refer Ind AS 109. There we are going to see the meaning of credit impaired, significant increase in credit risk, etc. There are some meaning for that terms. Some terms they have mentioned. I'll tell you. One example was insolvency proceedings have started. Not paying up to a certain time period. What about investment disclosure? Market value you have to disclose. If there is any impairment in the value of investment, that you have to disclose. And you have to also disclose the name of the company where you have invested, that is investee company's name. If you have subsidiary company, you have to disclose the name of subsidiary also. Okay. Then we will come to loans disclosure. If you have given loan, any loan to related party will be disclosed separately. Which standard deals with related party? Ind AS 24. So we will see there is a long list of related party and they will be disclosed if you have given loan. Same disclosure is there in this standard also. Then remaining classification is like debtors. For example, secured, unsecured, significant increase in credit risk, credit impaired, allowance for bad and doubtful debt. Again write here for this portion. Also refer Ind AS 109. Also refer Ind AS 109. Keep writing. Okay. When you will revise, you will be finding it useful. Now we are going to solve questions on Schedule 3. But before we solve a question, I want to give you some exam tips. Do you want to take it? Otherwise you will say unnecessary you are giving tips. We are already well educated people. You want? So first thing what you do, Anup is saying sure and Rahul is saying yes sir we want. Okay. And Aniket Kumar is saying you are the best teacher on this globe.
Yes, sir.
Why globe? You should say universe also, na? And multiple universe and all the solar system that exist. So first exam tip is you should read the question carefully. Now in this chapter, just to give you a heart attack kind of situation. Okay, do you want heart attack? Say yes. Question number 10. Question number 10 on page 2.67. This is a question on Schedule 3. It starts on page 2.67 and it ends on page number 2.69. And our font size is also quite small. In the institute question paper, it will be around 5 pages or 6 pages. Right? So you have to read the question carefully. You get 15 minutes before the exam when you can start writing. So read the question paper carefully in those 15, especially the long questions. And in Schedule 3 question, and also in other chapters also, you have to mark the dates because they will ask you to calculate depreciation, interest, which will depend on the dates, present value. then rate in the question, for example for depreciation, for income tax, rate, etc. Then there will be lot of names also, name of parent, name of subsidiary, name of other investor will appear. So take care of that. Second thing, you have to read the adjustment carefully, and if you are given a trial balance, take the item which have got adjustment, or if you are given balance sheet, P&L account, tick the items which will get affected. Use a pencil, not now. Then if item is already appearing in the trial balance, then it will have a single effect. It will have a single effect. You may have to bifurcate it. For example, question says loan is 550. Out of 50, 50 is interest accrued. So what I'll do, loan 500 will be non-current liability and interest accrued 50 will be current liability, but it is single effect only. Only we are just bifurcating into two numbers. But if you are given adjustment, like same adjustment, interest not recorded 50, then it will have double effect. One will go to P&L account, financial expense, and one will go to balance sheet, current liability, other financial liability. So adjustments will have double effect. If entry has already been passed in the trial balance, remember single effect. Only you have to adjust the numbers at two places. Then according to the given question, draw the formats. Usually in this chapter I will require following 5 formats. At least 4 I will require. SOPL, statement of profit and loss, SOCI, statement of change in equity, balance sheet, notes. Working note if depending upon the question. Like for example, for tax calculation, you may have to prepare a working note like that. So sometime we might require working note for tax calculation or depreciation calculation, etc. But otherwise not required. And very important last point, number 6. Institute is full of what should I say, questions which have multiple answers. So wherever you have doubt that it can be this assumption or this assumption, you write the assumption at the end of the answer. Is it right? So if you write assumption, the examiner will understand that you have made your answer based on this assumption. Like for example, only loan is appearing in the problem. It can be current or it can be non-current. So write down, we have assumed loan as current asset or non-current asset. Understood? So what I'll do, today we'll take question number 5 and I will solve in the book. Today you do one small homework on my behalf. Read this guidance note on division 2 of schedule 3 to the Companies Act, paragraph 7 in your book. Already I have explained most of it. Some more I will explain tomorrow. Okay. So you will not take much time. It is just about 2-3 pages. And to give you comfort, they don't ask question on this. So just you have a quick reading on this. The only question which I have seen till now is a question like the one we are going to solve now, or a similar problem. Not this one, but similar. So let us start question 5. We have limited time and we will solve in the book only because I have drawn the format for you. But in the exam, you will have to draw the format. So at least once you will solve the entire problem on your own in a notebook. We are in the classroom and we are bound by timing. So sometime I have to save the time. Otherwise to draw the format itself takes 45 minutes. Okay. The following information has been extracted from the books of P Limited for the year ended 31st March 17. So as I said, you have to underline the name of company. The year ending is 31st March 17. Then you are given figures which are rupees in 1000. Can you see that rupees in 1000? So we will also prepare our answer in rupees in 1000. Institute will agree for that, don't worry. Then you are given employee benefit expense. Okay, then where will you put employee benefit expense? P&L account, SOPL. Similarly, interest paid will go to SOPL. Then called up share capital will go to share capital in balance sheet. Dividend 6 is appearing. Debits column means dividend paid. Debit side means paid. Credit side means received. SOCI will deduct it from reserve, retained earning. Cash at bank will go to balance sheet. Income tax debit appearing, so it will go to tax expense. Remaining balance from previous year, so some amount was pending which you have paid. Okay. Warranty provision 90 will go to balance sheet under provision. Now it's not clear, is it short term or long term? Warranty can be long term also, short term also. If you buy a say calculator, 3 months warranty. If you buy a mobile phone, 1 year warranty. But if you buy a car or AC, 6-year warranty, 3-year warranty. So you have to write an assumption for that. Then we have general expense will go to P&L account. Land and building, will prepare a note for that. Cost is 1,10,000, 1 lakh, and depreciation is 48. Whether this depreciation is on building or on land? Building. So that is why they have not mentioned it. Students should know. Usually land is not depreciated. Then similarly, plant and machinery at cost, depreciation. Retained earning, opening balance on 1/4/16 means opening balance. Accumulated depreciation 1/4/16 means opening balance. Now 10% loan, 80, which means interest 8 should also appear in the P&L account. But how much interest is appearing is, you see here, 5, second line 5. What is the mistake in the question? When was the loan taken? Not given. You assume full year. And if it is full year, then 8 minus 5, 3 will appear as accrued interest. Accrued interest. Purchase will come in P&L account, sales will come in P&L account. Opening stock is given. This is opening stock 1/4/16. So we'll write in change in inventory. Trade payable, balance sheet. Trade receivable, balance sheet. Then we have additional information. Closing stock is given. So one effect will be change in inventory. One effect will be balance sheet current asset. Then building and plant and machinery are depreciated on a straight line basis. Very good. No residual value. Very good. Add the following rate. Building 5% and plant and machinery 20%. So rates are important. These are all per annum. Even if per annum is not written. Then there are no purchase or sale of non-current asset during the year. Very good. So no purchase or sale of PPE item. Income tax for the year to 31st March 2017. Income tax for 31st March 17 rate is 30%. But the calculation they have already done for you. 1,35,000. This is current tax. Next is the loan is payable in 5 years. So loan will come as non-current liability under that financial liability. Year-end provision for warranty claim has been estimated at rupees 75,000. Oh my God! So what you are going to do with that? Opening balance is how much? 90. Closing is how much? 75. So 15,000 rupees we are going to reverse. Is it right? Land has been revalued at rupees 1,80,000. And what is the cost of land in the problem? 1,10,000. So 70,000 will go to revaluation reserve. And because tax rate is given 21,000, 30% deferred tax liability will also come. Deferred tax liability will also appear. Required. Prepare P&L account and balance sheet on 31st March 17. So you have been given which formats? You are given SOPL, you are given SOCIE, balance sheet is given, notes is given. Under notes we are given change in stock and PP, other income and trade receivable. Is it right? And no, loan is not there. Just make a small correction. It is note 3 is other income. You make it other expense. Make it other expense. Note number 3 heading is other expense. Okay, so how do you solve? The way I have learnt to solve a problem of financial statement is go line by line. Item appearing in trial balance will have a single effect. So first you spread that trial balance item over different formats and then look at the adjustment and give the effect. So I am going to follow that. Some teachers or some students follow this also. They first complete P&L account, then SOCIE, then balance sheet. You can do that also if you are comfortable with that. Is it right? But I find that is little difficult because every time you have to continuously read the problem. Okay, if I have to finish P&L account, I have to read the whole problem from beginning till the end. Then if I have to complete SOCIE, I have to again read the problem from beginning till the end, so that nothing is missed out. But if I go line by line, we will not miss anything. And if it is very urgent to make adjustment, we'll do it. So are you ready for that?
Yes.
So we'll start with employee benefit expense. Do we have any adjustment in this?
No.
No. So come to P&L account, point B3, employee benefit expense amount, tell me.
170.
170. Then interest paid, we have discussed there is an adjustment here. So write here 10% of 80 because the loan amount is 80. So this will be 8. But the trial balance says 5. So remaining 3, I have to put it in balance sheet. So in balance sheet, we have current liabilities here. Under other, that other financial liabilities there. Accrued interest, write down 8 minus 5, 3. Please practice in notebook also. Share capital 200. So that will come in SOCIE. Share capital, opening balance 200. Just write here. I'll come back to this. Dividend 6 will come in SOCIE. Dividend paid from which reserve? Retained earning or revaluation reserve? Retained earning. Then cash at bank, balance sheet, asset side, current asset, cash and cash equivalent. No adjustment in that? No adjustment? No, 9. Income tax. This is last year income tax paid in this year. So come to P&L account, tax expense. You write in bracket here 10 and plus, because current year also we have to consider. This is 10. Warranty provision is 90, but there is an adjustment, says year end warranty provision is 75. So what I'll do, 15 I will reverse. 15 I will reverse. So how do I reverse it? Provision account debit to expense account, because last year we had expense to provision. So this year we will reverse it. So I have prepared a note number 3, other expense. In other expense I will reverse it. Second line, reversal of excess warranty provision, 90 minus 75, 15 in bracket, because we are reversing the expense. And what about second effect, 75, balance sheet, under the head non-current liability, provision for warranty, 75. Now next item is general expense. Again that note number 3. How much is that? 240. Don't take any total, anything can come again. Then we'll come to note 2, property, plant and equipment. Property, plant, equipment, you will write land opening balance, you will write rupees in 1000, so 110. Building 100. Wait. And then accumulated depreciation opening balance in building, right, 48. Plant and machinery at cost, 125. Plant and machinery opening depreciation accumulated, 75. Can you see that? Retained earning opening balance, SOCIE, retained earnings, second column, amount 270. Then 10% loan, 80. Balance sheet, liability side, non-current liability, financial liability, borrowing, 10% loan. Is it 80? Then purchase and sales will come in SOPL. Purchase is how much? 470. Sales, revenue from operation, 1300. Inventory opening is 150. You come to this change in stock, right here, 150 opening stock minus, I'll come back to this. Then trade payable, 60, where? Current liabilities, financial liabilities, trade payable, 60. Trade receivable, financial asset, trade receivable, current asset, 728. Why note 4 is written? Is there any note on that? Okay, let us write down first here. How much? 728. Assume secured, and then we'll transfer it to balance sheet also. 728. Okay, now trial balance is over. Additional information, closing inventory is 250. So one effect in balance sheet on the screen, asset side, inventory. Can I write 250 here? Balance sheet, one effect, inventory 250. And change in stock also we have to write, 150 minus 250. How much is that? 100. But we have a note also on that. Anyway, so if we have a note, we'll write in note first. Go to note. Opening stock was how much?
150.
Closing stock?
250.
So 100 is the increase in the stock, negative. Write down negative figure. Write down negative figure. And in balance sheet you have written? In P&L account,
SOPL also negative.
SOPL negative. Correct. 150 minus 250. Okay, adjustment number 2. Building and plant and machinery are depreciated on a straight line basis. No residual value on building 5%, plant and machinery 20%. But before that, what I will do, I will go to adjustment number 7. Land has been revalued at 180. So entry for revaluation of land will be land account debit to revaluation reserve. Revaluation reserve will come under OCI here. How much is that? 180 minus 110, 70. But there is a tax also. So there will be a deferred tax liability on this. 30% of 70. How much is that? 21. Negative. Okay, now we'll come to second effect of that. So first you come to PPE note 2. Where is PPE? Okay, note 2. Land, write down change 70. Is it right? And then we'll come to balance sheet for DTL. Come to liability side, you will find deferred tax liability here. How much was DTL? 21. And then you will come to SOCIE also. Come to SOCIE also. In SOCIE, what will you write? Revaluation reserve? No, net amount 49. Revaluation reserve net amount 49. 70 minus 21 net amount. And sorry, not negative. That is by mistake. 49. So the net effect on the reserve will be 49.
OCI also we get 21 negative.
OCI 21 negative, yes, that I have written. OCI 21 negative because revaluation reserve will increase your income, tax liability will reduce your income. Net increase in income will be 49, which we have written in SOCI. Okay, and in 70 separately you have to write in land and building, and 21 you have to write in balance sheet as a deferred tax liability. Now we'll come to that note number 2, which is spending. So we'll complete this note now. So first you tell me total of closing balance here 180, 100, 125, and then depreciation on building 5% of the cost. So 5% of 100 is 5, and 20% of plant and machinery cost 125, 25. So closing depreciation will be 48 plus 5, 75 plus 25. Net block will be 180 minus 0, 180, 100 minus 53, 125 minus 100, 25. So now we'll take total of all the columns. Start from here. 335, 70. This is how much? 405, 123, 30, 153, 252. Out of these numbers, depreciation for the year will go to P&L account. Net block closing balance will go to balance sheet. Is it right? So please come to balance sheet. PPE, how much you got? 252. And P&L account depreciation 30 here. Adjustment number 3 is not required. No purchase or sale of non-current asset. Adjustment number 4, income tax are estimated at 1,35,000. On the screen, P&L account tax expense 10 plus 135. So how much it comes to? 145. And what will you do with this 135, which is not in the trial balance? Balance sheet, current liability, provision for tax. So come to the last item in the balance sheet, provision for tax. 135. 10 is already in the trial balance, so no second effect of 10. Next line is loan is repayable in 5 years, so loan we have put in non-current. Year-end provision for warranty claim we have done, land revaluation we have done. But what you do, first to come to the notes. 1, 2 we have closed, 4 we have closed, only 3 spending. So how much is 3? 225. 1 is negative figure. 225 other expense in P&L account. Go to P&L account, 0.6 other expense, 225. Total of income side 1300. Total of expenses here 803. PBT will be 1300 minus 803. 497. Tax expense 145. So PAT will be 352. EPS will be 352. And how many shares are there? Go to the trial balance. 200. Divide by 200. EPS is 1.76. Other comprehensive income 70 plus 21. So this is 49. Actually, if you have space right here. And now total comprehensive income will be PAT plus OCI 401. 401. 49 I have already written in the SOCI. This 352 we will write in SOCI here. So first we'll complete the rows. 200 plus 270. 470. 352 plus 49. Presentation is important. And this is 6. Now take vertical total. 200. Second column. 616. 49. Last column. 865. Is it right? In balance sheet, share capital 200 and this 2 total will come under other equity in balance sheet. Okay. So come to balance sheet, share capital, write down 200. Other equity is how much? 665. Now you come to asset side. Tell me the total of the asset side. Tell me the total of the asset side. 1239. Very good. And tell me the total of liability side.
1239.
Tallied. Power of double entry system. This was a simple example. It was in one of the institute publications only. I have not written the year, but it was there. But that was simple. We will take 1 or 2 more advanced question also tomorrow. Okay. So thank you very much for watching this video. See you tomorrow. Bye bye.